All right. Hello, everyone, and welcome. Seeing the attendee clicker going up. So we'll get started in just a minute once we let everyone get in and get settled. Hello, everyone. Welcome to today's webinar. We will be diving into the how to master winery finances with the help of three incredible industry experts. My name is Laura Kendall, and I lead the marketing efforts here at InnoVint. We are very excited to be putting on this event today. The response we've gotten has just been huge. So without further ado, let's get started. And on the next slide, I'll jump into the agenda. Like I mentioned, we have a jam-packed schedule today. So to start, I'll go through a few housekeeping items before asking our speakers to introduce themselves. Then we'll jump right into the content. We want to prioritize as much learning today.
Looks like we lost Laura's internet there. I will continue. We want to jam-pack our content there, and I will give a current state of the winery's financial health. Then we'll spend about 40 minutes as a panel talking about some key challenges that we see wineries making, and then we'll leave as much time as we can for Q&A at the end. So some housekeeping items here. All of you are muted, but feel free to participate anytime in the chat, and we will address those as we can. We are recording this webinar, so if you need to drop early for any reason, we will send this out to you following the event. Feel free to submit your questions in advance. There is a Q&A icon at the bottom of your Zoom feed there, and we'll answer them at the end. And then we want your feedback. There'll be a survey at the end of the session, and we really look forward to continuing to produce educational content like this for you. So please make sure you fill that out. All right, without further ado, let's get into the introductions, and we'll start with Geni.
Thank you, Ashley. You should have introduced yourself first since you were the immediate host, but I'm happy to be here. I am a CPA. I work in Napa Valley. And all of our clients, I work in a CPA firm, Broke Markle Davis and Company, and all of our clients are wineries. So we're focused on this industry. I am originally from Greenville, South Carolina, which is why I don't sound like California. And I have the distinct pleasure to work in this incredible industry. Have been since 2007. And I'm happy to be here and working with the InnoVint team and with Erik. So over to you, Erik.
Thanks, Geni. My name's Erik McLaughlin. I am the CEO of Metis. We are a consulting firm that serves specifically the wine industry and the hospitality industry. We're most well known for our M&A advisory services, helping people buy and sell businesses in the wine and hospitality industry. But we also provide a full scope of financial analysis, forecasting, planning, services to support the wine industry. I started in the wine industry in the early mid 1990s and was an operator in the business for many, many years before exiting the industry with the sale of the winery that I was involved with. And for the last 8 years since, I've been helping others do the same thing.
Thanks, Erik. I'm Ashley Leonard. I'm the founder and CEO of InnoVint. InnoVint is a wine production software company that tracks and reports on all the operational activity at a winery and costing activity from the start of the growing season through bottling and finished goods management. We don't only support viticulture and winemaking teams, but also IT and compliance and finance as their operational resource and serve as their tech partners for all things production operations and cost accounting. My personal background, I've been in this industry for almost 2 decades. The first decade, I was a winemaker. I started in the cellar and matured into director of operations roles and general management roles for small and mid-sized wineries. And this most recent decade, I've been focused on running and growing InnoVint. If we're talking in decades, this next decade for me going forward, I really look forward to dedicating myself to helping wineries run better businesses. And that's why I brought Erik and Geni to you today. I've known them both for years, and just given their introductions, you can see how much experience and wealth of knowledge they are. Together, actually, probably separately, they've seen hundreds, if not thousands, of winery financial statements over their years. So we're excited to have this transparent, open conversation with you about where we see most wineries challenged today. And we designed this content to be accessible, but also ideally actionable, so you can take some nuggets away and improve, or at least consider aspects of your winery's financial practice a little bit differently going forward. So with that, let's discuss the current state of winery financial health and why we're here today. So a lot of you are probably experiencing the state of the industry right now. And if not, we're all a part of businesses. This is impacting everyone. Inflation rates are high, costs have gone up, margins are tightened. And in terms of wine sales, growth in wine sales have generally plateaued. That's all really important. These are current events that are impacting this industry. But that may also be why this content may feel a bit more timely than other times. But to be honest, the challenges that we're talking about today, Erik and Geni and I have seen for years. They're not new, they're longstanding. And we think the main reason is starting with this truth, that it is challenging to become a master at winery finances. I know this to be true, Erik and Geni do, and there's a few reasons for that. But first, there's this proof point of how many registrations we've gotten for this webinar. We've had over 550 registrants. Wine industry professionals attend this. And that spans across hundreds of wineries. I looked at the demographics. It's CEOs, GMs, winemakers, CFOs, controllers. And then on the service provider side, we have accounting firms, CPAs, compliance specialists, bankers. They're all interested in maturing this industry and improving our financial health and the financial stature of our operations. But to focus on why it's challenging, the number one reason is just an innate part of this industry. It is complicated to support. It is complicated from an accounting perspective, a tax perspective, and a compliance perspective. And there's a litany of reasons for that. To mention a few, one is the raw materials that we use, grapes, right? We either farm or source them. There's a lot of cash tied up in those long-term commitments. The manufacturing and production element of the wine industry is very nuanced, very unique. It's honestly why InnoVint exists, that wineries require curated software to help with these truly custom workflows. On the sales side, we employ multi-channel selling. We don't just rely on 3-tier and wholesale. We also have this beautiful thing called DTC, so we're able to sell direct to consumers. That creates some accounting complexity. We over vintage our inventory, both bulk and case goods. That has pretty major financial implications. Quality control, compliance, federal, state, local, et cetera. And then insurance, I could go on. There's so many reasons why it is so complex. And to complement that, another reason why this is so challenging is because it's hard to find information on best practice around these things. Everyone seems to have their own methodology. There's no single source of truth. And honestly, I believe there's more wineries that need support than there are informed, experienced parties to train and support them. We have two amazing ones here, Erik and Geni, but ultimately we need more people that are experienced and trained and able to help these wineries mature in this way. So this is the first, hopefully, like I said earlier, of many educational sessions that we can host with you. And you're here, it's great, you showed up, you want to improve in the same way that we hope to see you improve. So with that, let's go into the content. In our pre-call, we talked about the greatest challenges that we see wineries make, and we bundled them into 4 main groups. The first is poor cash management, or not really understanding the cash needs for growth. The second is inaccurately tracking how much it costs to produce your wines and reporting on your COGS. 3, ineffective coordination across departments internally. And 4, unsuccessfully collaborating with partners, with your finance partners. So let's kick things off with number 1. Mistake number 1, poor cash management. Erik, why don't you take this one first? What does this mean and why is it so important?
Well, the wine business is not a cash flow business. It is a cash intensive business. And a lot of people are coming out of, that come to the wine business, maybe come out of other industries that are a little bit, there's not as much discordance between what their P&L looks like and what their cash flow statements look like. But the wine industry is quite unique in the sense that it has a really long inventory carry, much longer inventory pipeline than most other industries do. And so particularly if you're growing as a winery, your cash flow will become quite disconnected from what your P&L says. And so understanding the true cash flow management of a winery is critical, because when most people will hopefully be looking at their P&Ls and they look at their P&L and it says, I'm making money, why don't I have any cash? And it's one of the most common conundrums that people find in the wine industry. And then you have to look from the P&L over the balance sheet, and you see your inventory growing on the balance sheet as you're growing as a winery. That's where all your cash is sitting. And so understanding the true cash needs for running a winery and how they're not in lockstep with what your actual profit and loss statement looks like is critical. And maybe the most common mistake or trouble that we see, the most common mistake that we see wineries make that get them in trouble is underestimating the cash needs for growth. So if you're growing, and say if you're a winery, you know, most wineries, depending on what your red white mix is, how long you like to barrel age, or what your varietal mix is, or how long you keep your case goods back, you might have at minimum 2 years of inventory on hand at a time, and hopefully not more than 4 years of inventory at hand on time. But most wineries are running about maybe a 30-month inventory of supply on time. So if you are making wine, say, with a 2-year lead time before that wine is sold in the market, and we'd say on average, we'd look at 2 to 3 years, and you're growing, you need to understand what are the immediate cash needs to support your future sales in the future. So for instance, if you are growing on an annualized rate of 25%, pretty strong growth rate, that annualized need, if you are making wine that will be sold within a 24-month period, which is a very short period, you actually need 56% more. You need to be creating 56% more inventory this year than what you're selling in that year. Meaning you're going to have a cash demand for 56% more inventory creation than what you're going to have current cash flow sales volumes to support. More commonly, if you're making inventory for, say, a three years in advance of sales, a 25% annualized growth rate over 3 years, you'd think, oh, wow, that's 75%. But the compounding effect of that is actually a 95% additional cash need vis-a-vis what your current sales volume is. So essentially, if you're growing at a 25% annualized rate, have a 3-year turn on your inventory, you need to be making almost double the amount of wine and have all of the costs associated with that right now as the amount of wine you're selling in this given year. So understanding that, so a lot of wineries think if they get into a cash flow problem, they get on the cash chase cycle, and they're like, okay, well, we're going to try and sell more. And the more we're going to sell, we're going to pull ourselves out of this cash flow situation. But the faster you grow, the more you accelerate the front end needs for cash. So understanding and thinking about your cash flow needs really on a 3-year horizon is how we need to be thinking about cash flow, particularly if you're in growth mode. If you're in equilibrium, then you're making the same amount of wine every year, you're selling the same amount of wine every year, then your cash needs are going to be more closely in line with what your P&L looks like.
Fascinating. Thank you, Erik.
So
Geni, what have
can
you
I
seen?
jump in there? So
Please,
Erik gave you a lot of stuff there. So one of the big problems is that as us accountants, and I'm in a traditional accounting firm, but all I do in the firm is advisory. And one of the challenges we have with understanding this cash versus profitability is that we accountants tend to be pretty bad communicators. traditionally. And the way we like to see stuff is in details and big spreadsheets and all that stuff, which I love. But for you to understand it, we need to come up with different tools. And that's one of the things that I spend a lot of time doing. So my role in the firm is part-time, and all that I do is advisory. And that is helping winery owners achieve the business results that they want. And so that's what, to me, advisory service is all about, is helping you figure out how to run a better business. So we can measure stuff and we can count things and we can give you all sorts of percentages and ratios, but it needs to mean something to you so you can take action on it. So what we do is try to translate different metrics so that you can actually see that this is where I need to focus my energies to improve cash flow. And I've worked with different kinds of businesses in accounting firms in Atlanta, and then moving here, and also have been in the technology side. And so what you have to do is take tools, look for a way to turn insights into actionable information that you can do something about, and then start applying it. So as Erik said, the big misconception is if I'm profitable, I will also always have cash. And in many of our wineries in this area, profitability is not the #1 focus, nor is cash flow. Often those owners focused on long-term recovery through the assets or brand equity that they're building. So we're thinking profitability, and they're worried about some other longer-term objective, and we're not even providing those metrics or insights. So we try to figure out where you want to go and then help you come up with the key measures for that. And cash, of course, is critical because you got to be able to pay the bills and keep your employees on staff. And so as Erik said, the thing we don't often show you is what's happening on the P&L in relation to that balance sheet. Most owners, the balance sheet is just a thing that the accountants make them do, and all of their focus is on that P&L. And so what you have to do is look at sales trends, as Erik said, growth in your sales, in relation to growth in inventory and also accounts receivable balances. So those two accounts, if they grow faster than you're able to grow sales, the cost is cash. And so those are the kind of things that we want you to look at. How do I compare this profitability or sales growth to what's happening over here on this invisible thing called balance sheet that shows me what I'm stockpiling for future sales? And so it's thinking that way. And again, oftentimes the lack of understanding, in my opinion, comes from the accountants not really having the time or skills to educate you on what's really happening. And I think that's across industries of all kinds, but it's so much more complicated and costly in our industry because, as Erik said, we have so many moving parts. So, I mean, that's really the challenge, is how do we break this down so that it can be meaningful when you look at this financial information that Erik and I think is all pretty and fun, right, Erik? We love those financials, but to many people, it's just scary and Greek. And so what we're trying to do is break that down.
Well, I think, as Ashley said as well, is that this is complicated stuff, and it doesn't often get the attention from winery owners and GMs that it deserves because it's not fun, it's not clear, it's not easy. So people put their hands up and then they look at it once at the end of the year, once they look at their financial statements. And we have to think about, I mean, there's really kind of two ways to think about our managing our finances. We are either looking at it as a windshield, or we're looking at it in the rearview mirror. And so we need to use the financial statements and financial planning more as a windshield rather than a rear view mirror. I mean, ultimately, the financial statements are just a report card on how your business is doing. But, you know, I'm a father of 4 kids, right? And so I've learned, like, I got to watch the progress reports along the way. So it's not a surprise what it says on the report card. So your annual P&L is your report card, but we've got to be checking those progress statements all along the way and tracking it along the way so we can make good decisions and we can make corrections along the way so we get what we want on that report card at the end of the year.
And Ashley,
sorry, go ahead.
Go ahead, Erik.
Oh, I was just saying, I see a lot of questions coming in here asking about benchmarking and normal and what it would be normal for some of these KPIs, which I think really kind of leads us into that next section around, you know, inaccurately reporting COGS and talking about what is GAAP versus you know, non-GAAP accounting and cost accounting, and cash versus accrual, which I think our next section, we're going to talk about some of the things that is actually a precursor that we need to talk about before we talk about benchmarking. So if we're going to talk about benchmarking, we need to determine, are we measuring this in English or metric, right? Like, what is the rule that we're using to measure it by before we can even benchmark it?
So we provide benchmarking for our clients. We do a scorecard across the wineries in our area because we find that it's very specific to the region that you are in. Many of the benchmarking tools that are available tend to be sort of generically blended across the country and across even countries. So what we also find is anybody that wants a benchmark, if the benchmark comes back that you have outperformed the average, then you will accept the benchmark. If you underperform, you're going to question the source of the data. So it's really interesting about that, how that works. But we go to benchmarks like farming cost per acre for our clients, because those are the kinds of things they want to see, not financial benchmarks, but operational insights, like the kind of data that is running through InnoVint. What am I spending on these things relative to everybody else down the street? And again, in our area, they're all in the same geography. So it's they're very concerned about how they compare to people right in the same area. There's also a company called Community Benchmark that provides benchmarks. They also give you current data on visitor traffic and things like that. So you can see if everybody else is getting a bunch of visitors and you're not, it may be something that you specifically aren't doing as they are. But I wanted to
Community Benchmark is a great resource, and a lot, depending on what region you're in, they have partnered with a lot of different associations in different regions to subsidize the cost of being involved in that. So, and it's the more people that are in, the better the data is going to be. So if you're not participating, you should be looking at it.
And it's interesting that people always want to know what the number is, right, Erik? I mean, what's the number I should have for this? COGS is percentage of inventory, what should it be? And there isn't one, because every person is focused on something different. They're different structural businesses. We have some people growing their own fruit. We have people buying fruit. We have people not doing their own production. We have people buying, bottled wine and putting their label on it. So the industry is so different. There's so many different ways that you can be successful in this industry. The number one question we ask is, what is it you're trying to achieve? And what is your exit strategy? Because if you're a winery looking to sell or merge, which Erik spends time in, I know, and acquisition or acquiring somebody, you have a very different set of objectives you want to meet versus somebody who's trying to build a legacy and leave it to the next generation. So the answer to any question, if you ask an accountant a question about anything like that, tax or accounting, what's the right number, the answer is always going to be, it depends, unfortunately. So, but the more perspective we can give you, the more useful we think the insights that we provide are going to be.
Yeah. I would add to that, though, that almost everything we would advise you to do in preparation for a sale are things that you're going to be happy that you have done, even if you're keeping the business, right? So the things that are going to make there might be certain strategic short-term versus long-term capital investment situations that would be different. But in terms of operational decisions, the things that we advise to prepare a business for exit are also beneficial to people that are long-term holds. So should we get into cost accounting? It's my favorite.
Let's move on. Yes. Mine too. Cost accounting. Yep. So mistake number 2. Go ahead,
and I'll start with that for a moment. And I built a bookkeeping business in 2018 and 2014 for wineries and closed it in 2022 because of lack of employees. Hard to find people there for that period, starting in 2022. And one of the biggest challenges we find from starting at the transactional level is that there's not enough detail recorded on the transactions as they flow through on the cost side. So if I'm getting an invoice in and I have a custom crush facility, for example, and I have a bunch of different products moving through that facility, I'm not breaking out all of the gallons that are processed and all of that movement and flow, which is the kind of information that InnoVint is keeping track of on the quantities. But I want to know, was this the cab-related expenditure I incurred, or was it something else? And so the more detail you can capture in that transactional application in something like QuickBooks or whatever accounting software you're using, the more useful it's going to be when you go to record and allocate those costs using the really cool capabilities of InnoVint. So InnoVint has the ability to allocate cost that you take out of accounting across your wine in different ways. So you can be very specific with your allocation. So you could do it by lot, or you could spread it across different categories of wine that's in your inventory and then spread costs that way. But the transactional insight has to start with what you're capturing when you get an invoice in. And so that's something that I think owners don't know. They don't know so much about what's going on the bookkeeping side of the business. And it really starts there with capturing data at the right level of detail. And then,
Well-
then we have costs that we need to spread correctly. And Eric, go ahead. You want to say something?
Yeah, I think there are several things that we need to do to get cost accounting right. And what you're talking about is the discipline around the details, and that's really critical. But there's kind of three pieces that need to happen to get there. First one, though, is making a decision to do detailed cost accounting. And let's put the elephant out in the room. The majority of small wineries aren't doing that. Okay, the majority of small wineries are either just doing vintage level cost accounting, and many of them, maybe even the majority of them, are doing it more on a cash basis than they are on a GAAP basis. And because it's now allowed from a tax perspective to be able to expense away a lot of things that we used to have to capitalize into inventory. And what I mean by that are the indirect costs that go into your COGS. So everybody's capturing their grapes, their corks, their capsules, their glass, their pack, their cardboard, their labels. Some people are capturing barrels and putting that into it. So we think about what are the ingredients, right? We're all tracking the ingredients. But what not everybody is doing, because the IRS does not require it, is capturing what we would call the allocated overhead, the labor, the occupancy cost, whether you own the building or lease the building, the portion of the utilities that go into the production side of things, and capturing all of that and putting that into your COGS to get your actual COGS. So you have to make a decision to do that before you are even paying attention to the kind of details that Geni is talking about that we want to track. So first we have to make a decision that we're going to track the true cost of goods. Then you have to pay attention to the details like Geni is saying. And then we have to have a system to be able that makes us capable of tracking all of that and flowing that through to the accounting system. So we need all three of those things, but it starts with the conscious decision to do that. And many CPAs, and I know we've got some CPAs, visiting here, are going to tell winery owners, you'll pay less tax if we just expense away all the production expense. That's true. That is correct. So oftentimes what we will advise wineries to do is, fine, let's run two sets of books then. We're going to have a tax set of books and we're going to have a GAAP set of books. And the GAAP set of books are what we're going to use for management. That's what we're going to actually use to understand our business. Because if you're a small winery and you're only putting in your direct input costs, your direct input costs are roughly the same as a large winery. Maybe they get better pricing on packaging and maybe they buy fruit a little bit better than you do, but you're in the same ballpark on your direct input costs. What's really not the same is all the allocated overhead, right? So if you're making 1 million cases or you're making 10,000 cases, it costs you a lot more per case to make 10,000 cases on all those indirect costs than it costs the winery that's making 1 million cases. But if all you're tracking is the direct input costs, you make the mistake of thinking you can compete on price because you make the mistake of thinking that your COGS are close enough to be able to compete with the winery that's making 1 million cases. And then you're going to make your pricing decisions about how you price your wine, what channels you can afford to sell through, what kind of pricing supports you can give based upon an incorrect understanding of what your COGS are.
So I just want to revisit what Erik said. You don't actually need two sets of books, and Erik was using a virtual concept there. What he's saying is that managing a business on a tax basis is the wrong thing to do, because we're being as negative as we can be with our profitability for tax purposes, because we want to pay as little tax as possible. And the things that we do for tax purposes are legislated agreements that we have to follow to get the tax return done right. And I've did taxes for 15 years in the CPA firm in Atlanta. So, I mean, tax is my background, but that is not how you manage your business. Managerial accounting is following a set of rules that are designed to be standardized across industries. And that's what Erik was referring to as GAAP, generally accepted accounting principles. That's what we CPAs must raise our hand and say, we agree to follow this set of rules. But that tells you what's really going on in the business. It allows you to match the revenues you generate in a period with the cost of generating those revenues. And if you're managing on any other basis than that, you're not getting an accurate picture of what it takes to be in that business. So that's why you want that. I really want to get the insights and be on top of this business so I can see when I'm going off the rails. And so that's what that's designed to do. But also, if you work with a banker or a lender or an investor, they're going to want standardized financials that are not presented in accordance with tax. And you don't want to present the most negative picture of your profitability to those people because it's coming from a tax perspective. So be very careful about how you're managing that business. And it doesn't mean if you're using QuickBooks that you have to have 2 copies of QuickBooks running side by side or have a separate behind the scenes set of books. What you can do in QuickBooks is just flip the view from cash to accrual, and you can see it both ways. And if you're not doing that, your accountant will convert from a books on GAAP to tax in order to file your taxes. We do that every year at the end of the year. So you don't have to run the business on a tax basis in order to get the taxes filed on the most effective way. So just to clarify some of that, and it's a big issue. And the worst thing we can see is somebody running their business on a tax set of books. And oftentimes the bookkeeper might think that's the way to do it because it's simpler.
But we have a winery owner that in the chat right here that said, my accountant tells me that this is cheaper and faster and less work. I hear that a lot. Yet that is true. Doing it on a cash basis is cheaper, it's faster, it's less work. But for all of these reasons, the cost of doing it that way is greater than the actual dollar cost and the time investment of doing it right.
So,
and I also commented on that too, that's why InnoVint exists, is to deburden a lot of those direct costs with your third parties, that by managing that within the software, it's already automated. So it's just a couple steps to capitalize those overheads that Erik and Geni are talking about, and you don't have to rely on a lot of man hours and billable hours from your service providers.
Yeah.
So what most accountants are doing and that don't know, and this is a big problem, the accountants who just do the tax work may not even know that InnoVint has that capability to spread the costing over the periods. And it's one of the things that we're working together to try to change, is to get more accountants aware that this capability exists in applications that the winemaker is probably already very, very familiar with, but they're not using the costing module. And so what I'm hoping happens in the industry is that the winemaker brings in the accountant at the end of the month to load the costs that are recorded in QuickBooks or whatever software you're using into the costing module, and then spread those numbers that I've already validated across the wine, so that now every month I know what that bulk wine is costing me. So at the end of the year, there's not a big scramble to figure out what happened with that bulk wine as it moves through the building. And then you can allocate cost. And when we're talking about overhead, I mean, one of the things we allocate is the winemaker across gallons on hand. We allocate some of the depreciation and some of those other costs that are actually incurred in order to get that wine into the barrel or into the bottle at the end of the day. So there's a lot of complexity. And if you wait till the end of the year and just spread it over the average, you're not going to get as accurate a cost as you want to do. And that's why InnoVint is so effective. I can go in each month, do it, allocate those costs, and then I can adjust it if I need to, and then continue to track those costs each month as they move forward. It's a much better way to manage those costs.
Well, and some of the reasons why you want to do that, right, are not just so we can have a more accurate understanding for our business, but so say your relationship with your bank, right? So most people fund their inventory on a line of credit, and that line of credit is usually a variable line of credit based upon how much security is there, how much inventory is there. And if you're undercapitalizing, if you're not capturing your true cost of goods, you're going to be understating that inventory on your balance sheet. And depending on what your arrangement is with your bank, some banks will just allocate a certain number of dollars per gallon based on bulk value, but a lot of them will look at it in terms of how much will they lend relative to book value. So if you're expensing away all of your production overhead, you're undercapitalizing what's on your balance sheet. So when somebody looks at your balance sheet, it looks like you have less stuff than what you have. And it will impact your ability to borrow, not only just on your line of credit, but in general, if you're looking at recapitalizing or refinancing your entire winery operations, and somebody's looking at how much security you have there to pledge against it, you're understating what your assets are. Which then, like for our purposes, if you were to go to market to try and sell your business, a lot of wineries don't make enough money that the valuation of their business will outrun the underlying value of the asset. So if you are not a high performing winery financially, the sum value of your winery is the sum value of your stuff. And so if you're not a high performing winery, you want that balance sheet to look as strong as possible. You want to show as much inventory there as possible. And if you are a high performing winery and the value of your business as a going concern exceeds the value of the underlying assets, well, you still want that balance sheet to look good. So when somebody is when that buyer for you is going to borrow money against it, or they're just value checking themselves, like, okay, I'm cool paying a 12x number on their EBITDA for this business, but gosh, what am I really getting for assets to back this? So the more distance between the valuation and what the net asset value is, the harder it is to get a lot of buyers really comfortable with that. So it's disadvantageous to not fully capture the value of your inventory for both of those purposes. You're also looking at and if you don't do it, it makes your financials look funny. Like I look at a lot of wineries that aren't properly allocating their COGS. And at first glance, when you dashboard it, you're like, wow, these margins are amazing. And then you look at their expenses and you're like, but what the heck is going on with their SG&A? Like their expenses are out of control. It makes your business look really funny. And if you're using the same measuring stick, if you're using the gap measuring stick, your business looks really funny. It looks like you're spending loads of money, way more than you need to, but you're achieving at margins that are way better than industry standard. So it just looks funny. So you want to get that more to normal. So a lot of people are asking questions here today about what are the benchmarks? Where should we be at our gross margin? Where should we be at our operating expense ratios? Well, you have to be a gap for anything that we tell you about benchmarking to be true, because you're just using a different measurement to be able to do that. So
I want to make a quick point. There's a question about cost accounting for tasting room and DTC programs, and the cost of wine stops at bottling. So any cost that you incur after that should be recorded as a sales or marketing expense. So the tasting room staff and all of that stuff does not get thrown into that cost of that wine in bottle. Once it's in the bottle, you're done. And that includes storage, movement of the wine and bottle across places. So the line is drawn distinctly at the point of bottling. And so all of that other stuff should be accounted for separately. And then if you want to see cost of revenue per staff or something like that, it's a different calculation, but it is not associated with the cost of that wine. Now, some people include other stuff in what we call above the line in calculating the gross profit, but traditionally the direct cost of that wine does not go beyond the cost of getting in the bottle. Let me see, Erik is waving his hand there. Go, Erik.
Well, I think Bree's question on this actually gets right to what our next point is. What our next question is what is the single source of truth? Are we thinking about the business differently based upon what function you serve at the winery? Do we think about costs differently from a DTC perspective, from an FOB perspective, from a productions perspective, from an accounting perspective? That's I think that's the next problem that we wanted to address.
I think, yeah, and I agree. And it is the next section of what we need to talk about. And one of the big challenges that we have is that we have each person in their own department with their own tool. I mean, for example, InnoVint, the winemakers are spending a lot of time in there and managing all the flow and all of the process that they're doing. And oftentimes they're the only ones seeing it. And so we have accountants over here with a spreadsheet with the same information that they're doing manually and not comparing it to what's going on in the winemaking side, the production and seller. And then we have salespeople recording their own numbers on sales. So we have this whole pocketed view of what's happening in a winery. And I've sat down with winery owner after owner and had them pound their hands on the table and say, why can't somebody tell me what I have on hand, what things cost, and who's buying right now? And it's because we're all spreadsheeting our way through the world. And it's so much more complicated for this industry because of these specialized tools that we're using. And we're not talking to people within our organization about how we can collaborate and get the same view of information shared. Again, that's why InnoVint, and I had a bunch of clients on InnoVint and doing their costing, and I would say, well, and doing their bulk wine movement tracking. And I would go, well, can't you do costing? And they would say, no, they didn't know that was an option because they weren't looking for it. And so getting accountants educated enough to ask the winemaker, do you use the costing module, or can you give me access so that we can do the spread for you, is critical. So part of the education, and that's why I'm so excited to be part of this, actually, is that we're glad you're getting the word out, because often we don't think to ask as accountants about what better way there is to use automation to get the information that we need. And also, they're not processes that are spelled out clearly, so that what's going on in each of these tools is done in a way that matches what needs to happen at the end of the day in the accounting application. Erik?
Absolutely, Geni. Yeah, and actually, you commented on mistake 3 and 4 that are related, right? We have silos within winery functional groups, and we're siloed in terms of internal teams and external third parties that are supporting you. So, how do we set better expectations here? How would you recommend empowering wineries to be more proactive and collaborative with parties that'll help them fine-tune this process?
Well, I think you just have to, I mean, you have to, as the business owner or business manager, you have to make the decision that you want to do this, because your CPA and your CFO aren't going to make you do it, right? So as the business leader, it starts with a decision to manage your financials at this level of detail, and then asking those questions of your partners, whether it's your internal or external CFO, CPA, and asking them to do the work for you and with you, and to help you do the work, because it's easier not to do it. And just like the winery owner that put in the chat earlier, that basically their CPA said it's easier and less expensive to not do this. And let's be real, the accounting industry is probably facing a greater talent shortfall than almost any industry right now. There aren't people graduating and going into being CPAs, and they're all struggling for staff, right? So they're not going to make you do it. You have to make them do it.
Which there's a question about what's wrong with tracking everything in a WIP account and then allocating the cost to the volume that was bottled. The problem you have there is that you haven't accounted for the cost of different components that get blended to create whatever gets in the bottle. So you're doing an approximate view of what the costs are, and it may not be accurate at all. I mean, I could have started out with a very expensive grape that I'm bottling and then blended it across a bunch of different brands and not reflected that cost accurately, in terms of like one label could have 90% cab and another one could have 10% cab, and allocating just on volume may not reflect the cost correctly. So, I mean, it's an approximation, but I want to say that you do have to consider the cost of completely detailed cost tracking with the value of what you get. And there are people that go to the cork and track every single cork, and that's ridiculous. So we have to decide at what point is it most effective and meaningful for me to track cost. And again, because of what InnoVint lets you do, you don't have to get worried about it at too much of a detailed level. You can get very specific in allocating different costs in different ways and get really accurate information that helps you run the business better.
Mm-hmm. Yeah, there's some interesting questions in here too about, like, does storage costs go into COGS? Does shipping costs go into COGS? I think that's more into the weeds than what we have time to get into, but it is it illustrates the point that even when we are doing GAAP, there are judgment issues as to how much of that owner winemaker's salary are we going to allocate to production versus into SG&A. Are we going to incorporate pre-bottling shipping costs of moving bulk wine from one place to another before bottling into COGS? I would say yes, but some would expense it. That's a gray area. I think it stops, as Geni said, once you finish that wine and put it in the case, COGS accumulation stops. I've seen people try and allocate, warehousing and shipping costs to COGS. I don't think that's right, but I think that's in the weeds.
There are lots of different ways. And one of the things that we're allowed to do as accountants is to follow industry standards. If an entire industry agrees that something is an appropriate way to track things, like for our industry, inventory is not really a current asset. In accounting language, a current asset is something we expect to turn over in a year. And inventory in the wine industry, at least in our area, doesn't turn around in a year. It's multi-year. It's multi-year processing for cab and other wines. And so by industry convention, we treat it as a current asset, which means it can be converted to cash in a year, but often it's not. So there are things like that that we are allowed to make industry specific agreements, and then everybody in the wine industry follows those. But generally there are a set of rules and we follow those across all industries. Also, we had somebody talking about IFRS. That's international financial reporting standards that we currently do not align with in the United States. And there are some differences in how they record different costs. So if you're part of a multinational company, you may be reporting under that standard as well as GAAP for the US, and then a tax basis, which means, again, you're not keeping 3 copies of QuickBooks. Somebody's doing conversions between each of the different sets of accounting rules. And that's what's complex about this. Tax accounting rules are so very different from financial statement reporting rules that you need to be clear on which way you're viewing the financial results for your business.
Well, I think our second question here is really around the coordination between departments, and I think Geni hit on it earlier about having one source of truth with COGS, right? So then once you have that information right, then your that should inform all other departments about what they're doing. And we see a lot of, DTC is working off their own worksheets. National sales is working off their own understanding about COGS and what margin expectations, and winemakers are working off their own notes. But I think we just have to think of it conceptually as accounting is the owner of the truth. That's where the hymnal is. We all need to read and sing from that same hymnal on COGS, and then use that to inform out all of the other departments of the winery.
So should we talk about collaboration with our finance folks? We know y'all love us accounting types. You want to take us to lunch every day if possible. What I want to tell you is there are different numbers people with different sorts of focus on the results that you have in the business. So financial accounting, GAAP, generally accepted accounting principles, is a standard way of reporting information on your financial statements. It is the managerial way of reporting numbers. And so that's what a bookkeeper is going to be focused on. And that's what your CPA is going to be focused on at the end of the year. And then they're going to take that book financial information and convert it to tax for filing your tax returns. So if you go to the bank, they're going to want to see that financial statement reported in a standardized way, and that is the GAAP, GAAP. But the bookkeeper is going to be focused primarily on getting the transactions in and coded correctly and managing the bill payment and all that stuff. Typically, a public accountant is going to take the information they prepare and then add a level of oversight. What I'm trying to get accountants to do, and I speak at accounting and tech conferences all over the place, trying to get more accountants to have conversations with business owners about what these numbers really mean and how they can make improvements, and so that we're not as scary as you might see us. Your internal accountant is the place to start in your company. Ask them questions. Use them as a partner and help them enlighten you about the kinds of process decisions they are making and how they handle some of the expenditures that you might incur. And then also talk to them about this whole COGS issue and applications that you can take advantage of to make it easier for them and more insightful for you. So I really encourage you to form more of a partnership with the accounting team and with everybody else in these other areas so that we're all speaking the same language and working towards the same objectives. Erik?
You're muted, Erik.
Sorry.
There we go.
We've got a lot of questions here about benchmarking and what is normal and what is right. And I think we've sufficiently preempted to say, okay, let's get all to the same unit of measure before we can talk about that. But then let's be fair, let's talk about that. Okay, so for me, when I see a winery's financials, if your gross margin is less than 40%, you have a problem. Okay, that's the red line, right? You need at least 40% gross margin. Now, I've seen unusual business models, super asset light, high customer concentration, very low expenses. Sure, I've seen it. I've seen successful businesses that are unusual below that. But if you are anything that we consider somewhere near a normal winery, you need at least 40% gross margin to be able to cover the selling expenses, the administrative expenses, and yield a net margin. And obviously, the higher you are above that, the better. So 40% that's the floor. Get up towards 50%, you're looking good. You get up towards 60%, you're killing. Okay. And anything above 60%, now you're an anomaly in the other direction. So that's the zone. This is all presuming you're doing GAAP cost accounting. But that's kind of where you need to be from a gross margin perspective. And then from an EBITDA perspective, how we look at businesses is that, let's just say half of wineries aren't actually turning a profit, right? So we're going to set those aside. That's not a business. That is something that's working towards being a business. But if you're not making money, you're someday hoping to be a business. But if you are making money, and maybe I should back up and explain EBITDA. So a lot of people here understand, but EBITDA is earnings before interest, tax, depreciation, and amortization. So the concept is essentially we take all of the non-cash expenses in a business. We take your P&L and then all of the it's not interest, tax, and non-cash expenses. So because interest and tax, those situations can be unique. You could be a winery that owes a lot of money or doesn't owe a lot of money, but we're trying to distill your business down to its raw economic output. We're trying to get everything onto the same playing field, regardless of what your debt service looks like. So we add back the interest and we add back tax and depreciation. We add back tax on a corporation where it's paying tax directly through the business. A lot of these wineries are LLCs and they're pass-through entities, so they're not realizing income tax in the winery financials, so that's not even an adjustment there. If it's a corporation, it's different. But then depreciation and amortization are expenses that you realize on your P&L from a tax perspective, but they're non-cash expenses. So we add all of that back and we get what is your raw economic output, and that's EBITDA. And when we see somebody that is below 10% in EBITDA, you have a job. You have something. You're trading dollars. You're staying in business. You're chasing your tail, and you're trying to get at it every day. If you get a business that's between 10 and 20%, you have a business that is showing some potential, but is not yet a high-performing business. But it's something that you're probably making a decent living. You're probably paying yourself okay. You get a business that's between 20 and 30% EBITDA. Now you have a strong performing wine business. And then you get above 30%, you have a very, very high performing wine business. And we've seen a few above 40%. That's very unusual. Now you're just, like killing and trying to keep your head low and not let people know how much money you're making.
I'm going to do a quick time check here. We have 6 minutes left. For those of you that haven't noticed, that Erik and Geni are answering questions in that chat window. Thanks you guys for doing that. That saved us the time of having that dedicated portion. But since we have 5 minutes left, let's just conclude with, if the listeners could take away one key thing from this hour conversation, what would it be? Geni, why don't you go first?
I think the number one question you should ask as a person working in a winery, as an owner of a winery, is what are the assumptions we're making about how we track and manage the transactions that flow through the business. So accountants can make decisions and assumptions about what they code and how they treat certain things. And I think I would make sure that you had a clear understanding of what those assumptions are that they're making, and meet with your accountant and find out what they're doing, what kind of inventory costing method they're using. You can elect different ones, how they treat sales. When is a sale for their purposes? All of those things that influence the kinds of activities that you want to be monitoring in that business.
Yeah, this sounds. I'm struggling how to articulate what I want to say here, which is I want people to stop thinking of their wine businesses like a cash flow business, because a lot of wineries get caught in the cash chase cycle. And it's like, okay, we're trying to make payroll. We've got to pay our grape vendors. We got barrels coming next month. And so we're caught in a cash chase cycle. And so then it's like, okay, well, we're gonna discount this wine and do a few pallet sales and go do a road show at Costco and move some wine out the door. We're not going to make a lot of money, but we're going to get the cash that we need. And so we get caught in this cash chase cycle. And so we need to stop thinking about and acting on our business like it's a cash flow business, but what I mean by a cash flow business is something where you're like week to week, just trying to move from here to there, and start thinking of our business as a cash flow business on a 3-year window. We need if you can think about what are your cash needs and what is your cash inflow and outflow look like over a 3-year trajectory, you can make good decisions. And so that's the main takeaway.
So planning, budgeting, and forecasting are highly valuable, especially in this industry.
Yeah, and planning it on a cash basis, because it is often, as I said at the beginning, one of the most often mistakes is that the answer to the problem is more sales. And oftentimes the faster you grow sales, the more you exacerbate your cash crunch needs. So you can only go to that well so long before you have to refill the well. And you have to refill the well far enough in advance, so you're going to need the cash to do that. So you can run down your inventories. And we saw a lot of wineries, say, in California and Oregon, where there were a lot of fire issues and people made less wine and relied upon the inventories that they had backed up. And that got them through. But what we saw then is those inventories got squeezed, and then it created a demand for more production. And we saw a grape shortage in Oregon in particular in kind of 21 and 22, when it was a grape overage going in before the fires. There was a grape overage in 2020. So we flipped from, Oregon's probably a great example of this, macro, it flipped from a grossly oversupplied to grossly undersupplied market in a single year, largely because of a natural disaster, and people had to rely on their inventories, and that got them through a year, but it only bought them a year.
Fascinating. We could talk for hours more. Thank you both so much for participating in this hour. I think it's been enlightening to all of our attendees. For those of you that answered questions, if we didn't answer your question, Erik, Geni, or my team will get back to you and answer those. Laura, do you want to bring us home?
Yes, that'd be great. I want to thank everyone for attending today's event and extend a big thank you to our speakers. We'll share in our follow-up email, in addition to the recording, how you can stay in touch with the 3 folks on the screen today. And we just have a couple of closing things. As Ashley mentioned, we'll reply to any questions that we didn't get to. But for those of you that are interested in continuing the conversation with your peers, we encourage you to join our free winemaking community, the Punchdown. So you can see that link on the screen. We'll share that as well. You'll find different groups there, ask questions, post wine jobs, learn about some of the upcoming events across the industry. And there's also a marketplace where you can buy, sell, borrow, lend, anything that a winery might need. And then lastly, we also just launched our very first harvest recap dashboard. So this is kind of a first of its kind interactive report that would be super interesting to anyone that, that's a data nerd and wants to peruse some of the wine industry data, particularly around wine production and the harvest season. So take a look at that URL, play around with it, and let us know what you think. And with that, I want to thank again everyone for spending time with us. We look forward to bringing more content like this to you, and have a very wonderful holiday season.
Thank you.
Thank you.